Mark Matthews, Head of Research with the Bank of Julius Baer Asia. He's ready. We can connect with him. He joins us live from Singapore. Mark, good morning. Thank you for joining us. Mark, are you pleasantly surprised with the resilience global markets are exhibiting? S&P is at a 5-year high. And if I map the economic environment is not all that constructive.
Well, I'm sure you've heard this before, but it's one of those bad news is good news things, because as long as the growth remains very, very subpar in Europe and in the US and now Japan, the governments and the central banks are doing as much as they can to ameliorate the situation. Well, I guess I need to be more precise. Not in Europe, the governments can't because they're embarking on austerity. But in the other countries, yes. And so the central banks have underpinned markets with monetary stimulus. And then I think, broadly speaking, there are preliminary indicators that the global economy is on the mend. I would point you to Korean or Taiwanese exports, for example, which tend to be a bit of a leading indicator, or the U.S. December imports, which were announced on Friday, up 3.8%. All of this is guiding us to a gradually improving situation globally. European crisis on the back burner seems to be fading away, and China no longer the headwind, now a tailwind in 2013.
Mark, hi, morning. So just to stretch that point forward, in 2012, India saw FIIs pumping in about $25 billion in equities, which was the second highest figure ever. Would you expect that figure to be topped given the accommodative monetary policy stance in the US as well as Japan and the rest of the developed world?
Well, the emerging markets have a history of going up more than the market, the broader world market in a bull market, and then going down more in a bear market. So if we are in an environment this year where equities are going to rise, which I think we are, then if history is any precedent, unless there are major accidents in India, the market should do quite nicely. FII should continue to come in. India seems to be making the right noises. I don't think it's on the headlines of any papers, but the fact is that there are still articles about India, and the tone is positive.
Mark, US lawmakers have managed to avoid the fiscal cliff crisis, but there is still no consensus on spending A, and there is no consensus on how the US debt ceiling will be sealed. Is that something which do you think could bother global markets going forward?
Yes, I think that probably in a couple of weeks it will get very noisy as a result of the impending battles in Washington. But without wanting to be too complacent, if we premise our investments on this kind of noisy news flow, if you look back in history, it really didn't end up making you any money trying to weave in and out of equities based on what politicians or central bankers did or did not do. It's very difficult to forecast. I think the bottom line is that they probably will find some kind of agreement on these various issues, the three major issues actually that have to be dealt with. But if they don't, the world will continue to function. And I think perhaps as time goes on, that's something we're becoming to increasingly realize, that politicians can create a lot of noise, but the underlying economy in the world continues to trundle along anyway.
And some would argue that markets are now used to their bluff and they are used to the last-minute negotiations. So, Mark, do you think 2013 will be a year of austerity, or 2013 will be a year of global growth? At a time when just about every central bank is printing money, do you think general growth could make a comeback?
Well, once again, it's trying to preempt politicians. I think that in America, you can't deny there's a massive debt that is unsustainable, and that tax and entitlement reform will need to happen at some point. But this conversation could go on for hours about whether they become too austere or just a little bit or not at all. I honestly can't predict it. So I just think we want to focus on the fundamentals of companies, which seem to be doing okay to me, and Although there is this noise in the U.S., I think there are other forces which are quite constructive in America. For example, the ongoing recovery in their real estate market, and real estate in America, like any country in the world, has a massive multiplier indicator on the broader economy. And then, as I said earlier, in Europe, it seems like things are actually quietly getting better in the peripheral countries. Germany has an election in September or October. I don't think they'll want any big accidents happening in between now and then. And Japan and China, which were both headwinds last year, are tailwinds now. So all told, I think it's a year to be constructive on equities.
Mark, when we started the year 2012, expectations were low. But for 2013, expectations from Indian markets are high. Do you think the rebound in the real economy, corporate risk appetite, investment cycle and demand will lack expectations, and going forward in Q2, markets will be disappointed?
No, I actually think that the mere fact that India has gone from doing nothing, which really I think is not too bold of a statement on reform, or even going backwards, as we could see with Vodafone and Mauritius and things like that, to now going forward with reform is the very pivotal thing. And even if they don't deliver on a lot of the things that they said they would do, just delivering on some will be enough, I think, to keep the market buoyant. As for the economy, we're not looking for a big rebound. I think we're looking for about 6.5% GDP growth this year, up from 5.5% next year. But the combination of those factors should be enough, I think, for the market to be fine this year.
Mark, you just reiterated towards accidents in the Indian economy. What is it that your biggest fear is in terms of what could actually spoil the party?
Well, I don't really have any right now. I suppose that inflation remains a bit of a bugbear, and the industrial production was a fairly weak print in December. So I suppose there's a possibility that the economy could be a little less robust than we expected. But as I said, we're not expecting a huge recovery anyway. I honestly don't have a whole lot of negatives to share with you right now.
I would like to draw your attention to global volatility. At a time when the event risk is still high, what explains the sudden drop in global volatility? If I map the CBOE VIX, the CBOE VIX is at a historic low.
Well, maybe it was something you said earlier, that markets have finally learned that they should just become a little bit immune to the noise and look past it. And that's the only thing that I could think of that explains it, because you're right, there is a lot of economic policy uncertainty, and yet volatility correspondingly is very low. So yeah, I would think it's just that we've become a bit immune to it.
Mark, what is it that you're expecting on the macros? Because they are not entirely stacking up well. Like you just reiterated a while back, industrial production has seen a dip in December. Inflation levels are still pretty high. And the twin deficits as well continue to dominate headlines. In such a scenario, what do you think the RBI is going to do, or rather the Reserve Bank is going to do in its month-end policy?
Well, I think it will want to pat the government on the back a little bit, so I would expect a 25 basis point cut, but perhaps not the 50 that the consensus is looking for, precisely because there are a number of issues that remain outstanding in terms of the twin deficits and inflation and whatnot. I do think that gold imports need to be combated more vigorously, and if the oil price comes down, of course, that would be very beneficial. I think over the long term it will. It's hard to really gauge the short term, but over the long term, I think it will. So no, I don't really feel like the economic situation is bad. It's just that India, like much of the emerging world, by the way, is becoming accustomed to a lower top line rate of growth than it had over the last 10 years. But nobody should be surprised at that. I mean, an economy can't keep growing at 8 to 10% forever. You reach a certain size where it just gets impossible or very dangerous.
Mark, do you think 2013 could be a year of a strong start and a slow finish? Because as of now, markets are of the view that growth will dominate global markets, but in the second half, maybe excesses and political problems could surface up.
I don't see that. I don't really see the political risk in the second half. I mean, there's a federal election in Germany, but I think that Merkel will win it. And in Japan, the new government is firmly in power and doing a very good job, by the way. And in China, the leadership transition has been, I think, quite smooth, and they're past the kind of scandals that they had last year. And that leaves us with the U.S., which will continue to simmer away with fights on Capitol Hill, but we're becoming a little bit immune to it. So, no, I don't really see that bifurcation in the markets between the first and second half. Of course, it's just intuitive if we were to do very, very well in the first half that we'd cool off in the second half. If something goes up too much, it does need to cool off or come down. I'm not really forecasting that either half will do better than the other, actually.
So, Mark, when it comes to India, what sectors do you think would actually hold up, and what is it that you're negative on when it comes to sectors in equities?
I'm sorry I can't get granular with you on India because I don't cover it as much as I should. But I would just say that in a environment like the present, where people are looking for high returns and willing to take risk, then it's intuitive that sectors like engineering or real estate would outperform, especially if we get an RBI rate cut.
Mark, you're making a case that China is no longer ahead when in fact it is a tailwind. So if Chinese economy indeed makes a comeback in the second half of this year, do you think potentially that could disturb the inflation setup? Because if China makes a comeback, commodity demand will also make a comeback.
Well, I think that the new Politburo has been explicit's not the right word, but the new Politburo, if you read closely what they said, they're shifting emphasis away from fixed asset investment, and the tone of the language of the Politburo meeting in December was very, very different from that of July last year, where they said they wanted to continue to do a lot of fixed asset investment. Well, in December they said they wanted to limit fixed asset investment because there was overcapacity and a lot of these industries were polluting. And so that's the kind of thing that creates demand for commodities from China, not consumption. What they want to put their emphasis on is consumption. So even if the Chinese economy picks up, I don't think it will be a result of them building a lot of new airports and highways and that kind of thing. They already have enough. And therefore, I don't think there would be a pickup in commodity demand.
So, Mark, at a time when global liquidity is abundant and it will remain abundant for next 2 or 3 quarters, do you see a situation that money could move out of US bonds, German Bund, and it could revisit emerging market equities? Because, Mark, what has dictated global money managers in the last 2 years is dividend and diversification. Do you think now risk will make a meaningful comeback?
Well, actually, if you look at asset allocation in the U.S., it's incorrect to say that people are very underweight equities. They are, if you look back over the last 60 years, basically in line with the long-term equity asset allocation. And where they're very underweight is cash, and where they're very overweight is fixed income. And I actually don't foresee the fixed income market really changing very much, even though it's done so well, because you can still clip a decent coupon in high yield bonds. And I do think that the Fed will keep interest rates low until unemployment gets to 6.5%. And just looking at the trajectory of how it came down from 10 to 7.8 where we are now, I think that it would be it wouldn't be possible to get to 6.5% unemployment in the U.S. before, I guess, broadly speaking, sometime toward the end of next year. So I think that we've got a good, clear stretch here of about 18 months where interest rates will remain extremely low, and we're going to get more quantitative easing. And that backdrop, I think, makes calling for a rotation out of bonds premature.